AgCountry offers a wide range of internal growth. If you have a goal in mind and you put your mind to it, your successes can be endless.
There are so many jobs within this company that you can rotate into.
I like challenges. AgCountry gives me challenges.
Yeah, AgCountry is a great place to work. There's plenty of flexibility. You're never tied to your desk. There's a team here that is always there for you.
Yeah, grab your role and run with it, and always be aware of the opportunities because they're in front of you.
We're going to talk a little bit about using your crop insurance as a marketing tool. So we're going to cover a basis of marketing and crop insurance and kind of the combination of the two. They've both evolved over the last few years, or say the 20 years. There's a lot has changed in those tools and how they work. And so we're just kind of a little bit of a refresher on that. So, and again, like most people in here, they're probably not like me and they don't get real excited about insurance, right? I'm kind of one of those weird ducks. I get excited about it. But same thing with marketing. Marketing seems to be a struggle for a lot of our producers in knowing when to pull the trigger. And with all these new tools and advancements in how they work, help you mitigate that risk, the market risk that's out there. And so that's what we're going to kind of focus on here today. So again, we're going to talk about the evolution of crop insurance and how that's changed over the years, and what those tools are and how they can be used, as well as what risks do you want to mitigate. You guys kind of have to decide what risk do I have that I want to mitigate and take off of the farm and maybe place on somebody else. That's what insurance does. Insurance removes the risk from you and puts it onto somebody else for a premium. You pay for that, but then you don't have that risk, and then that pays out if you have a loss. Instead of you facing that loss, the crop insurance or the insurance company will take care of that. And that gets to my correlation between the marketing and insurance, really talking about ensuring that market and ensuring the market movements of what could possibly happen there. So very informal. If you have a question, raise your hand. I think there's a mic around here somewhere that we can capture that, and we'll have people running around to help get those. So if you do have a question, raise your hand. I'd rather have it interactive than me sitting up here and just talking, so please do so. First off, I want to talk about is you never can get rid of all of the risk. And every producer has a different risk. They all have a market risk depending on the crop that they're raising, or I should say commodity, whether it's livestock or a crop. You all have your own market risk. There's also local basis risk, so the cash risk of how things can change. Most of our markets have, I would call them a national market or even a world market that is traded or moving back and forth, up and down. But then you have your local risk. And so you're always going to have to do something like that. There's no tools to take out everything. We can never mitigate 100% of the risk. The tools are just there to help you mitigate it. And in today's are just examples and ideas of how you use the current tools in your toolbox to do some of that. And so that's the goal for today. I throw out some of these business principles. I look at it from, at AgCountry, obviously we have lending, we also have insurance. So we look at things, as far as running a business, what are some things we need to consider? Knowing your break even is number one. As a producer, as a farmer, you need to know, what does this cost me to raise, produce, create? And then at what point am I going to start selling it so that I can make money? That's everybody's goal, I think, that farms, right? It's obviously a lifestyle for a lot, but also the goal is to make money and to increase your balance sheet, increase that. You have to cover your costs and get something above that. Pay for your family living. You have to pay for the taxes, things like that. I look at avoiding locking in a loss. If the prices aren't there where I can actually lock in a profit, is there something else I can do to help avoid a loss? And so instead of locking in that loss, look for other tools or other ways to prevent that. Establishing risk floors as soon as possible. If we get to a level that I can take the risk off now and I can be profitable, why not lock that in and still have some upside potential? A lot of tools will still allow that upside potential. Some tools will not, but are still good tools. You just have to know what they do. So those are some things to consider as well. Execute any opportunity to cover that cost. They kind of go hand in hand, right? They kind of go together. Once we've covered that cost, is there a way that we can execute that opportunity, take advantage of the opportunity as it provides or presents itself? And then also elevate that minimum risk. A lot of tools you can just keep rolling up. You can keep moving up as the market goes in your favor. Just keep raising that floor. And that's just locking in a little more profit potentially and stuff above those costs. So these are just some principles that I would look at you to consider when you're running your business and your operation. I know there's a lot up here. I'm not going to go through it all. But the evolution of crop insurance has come a long ways. I don't know if any of you were farming back in the 70s and 80s, when, pretty much we had hail insurance, right? And then we kind of had the federal crop, which helped, cover the production that, you don't have. Hail protected you on what you lost, not necessarily make sure you have a floor. Two different ways to look at it. A lot back then we focused on ad hoc disaster programs, which really is what the government did to help the producers to stay profitable or to stay in the business. We had these ad hoc disaster programs. Multi-peril crop insurance came into existence where we had little elevated coverage levels. Instead of just that 50% coverage level and half of the price, we could start buying 65, 70% of our average. And then the government still had their own price that they locked in at that time. But it was at least a little better coverage than what you had prior to that. And so the evolution just kept going. From there, we basically went into what we call a revenue protection. And that's the vast majority of crop insurance out there today has some form of revenue as part of it. So revenue is measuring the market movement, protecting you from market movement, as well as the production side of things. So you look at your farm, what's your average production? What do you average or what do you raise? You want to buy 75% of that or 80 or 65. Again, you make the decision. You choose how much of that to protect on your farm. But as you can see, we went from a really low protection with ad hoc disaster on top of it to try to help out, to now there's been a lot of discussion about, do we want these ad hoc disaster programs, or do we want a good, strong crop insurance program that eliminates that and truly measures, based on the production and revenue that you have on your farm or in your area, to help those producers that suffered a loss or a disaster event. And so again, it just continues to, and we went now into whole farm revenue, to livestock plans. Whoever thought we'd have a livestock insurance policy? There's livestock. Now it doesn't protect you from death, but it protects you from movement in the market. An LRP policy, things like that. Supplemental coverage options, part of the farm bill that came out when we were talking about farm programs, and our farm programs started cutting back. They added to some of these products as well, and help you produce or help you protect yourselves, or different area plans with margin protection, enhancement, all these different, a lot of acronyms as you can see up here, and I'm not going into details of all of them, but again, we've just come a long ways, and the vast majority of what I've seen is the evolution of insurance is more to protect market movements. There's a lot of marketing tools. We got futures, we got options, puts and calls, hedge to arrives, we got all kinds of stuff out there in the market side, but it seems like producers have been a little hesitant to do all of them, and they're still looking for something where they know what they've got. And that's what you have with an insurance policy. You know that if the market moves a certain direction or your production moves a certain direction, you're going to get paid. And you pay you know what it costs you. There's no margin calls, there's none of that. You pay the premium, you pay the crop insurance premium. In most cases, it's subsidized. But that's where we've kind of come in the evolution of insurance. So I talked about individual plans versus area plans. They both have their place. Again, sometimes we need a vice grip, sometimes we need a crescent wrench, right? Two different tools basically do the exact same thing, but you might need a different way to do it. You want to clamp it on, or can it slide on like a crescent wrench and just fit? This is no different. You have an individual plan with the revenue protection and whole farm revenue. Looking at your farm. Did your farm produce enough production and price with the revenue, or did it not? And did you suffer a loss on your farm? Now, those have higher deductibles. For an individual policy, typically, we can only get to like an 85% of average protection plan. The area plans, based on the right, is based on just what I said, area. It's based on maybe your county yield, as opposed to your individual yield. Now, your individual yield sets up part of that average, but it doesn't complete, it's not all of it. So you may personally suffer a loss where your county doesn't, you don't collect. But vice versa. Maybe you're in the part of the county that didn't get hit with the hail or didn't get hit with one of those storms. You had above average, but the county overall suffered. And so now they're looking at possibly making a payment there. We've seen that a little bit in the ad hoc disaster programs where they try to isolate certain counties and only pay certain disaster counties and then the contingent counties around it. This is a little bit different, where it's just strictly based on crop insurance in your county specifically. It doesn't matter the contingent counties, and you may not qualify just being in a contingent county. So some may struggle with that concept that are right on the edge of a county or maybe in two different counties. But it's really protecting that revenue. And again, it has, just like your individual, we have a projected price that we start the policy with and a harvest price, because that's the market movement. That's the market insurance you're buying. Area plans, you can buy up to 95% of the expected revenue. So a little bit higher than that 85 on your individual. Think about whether it's your home you buy. You want a $500 deductible, a $1,000, a $2,000, $2,500 deductible? You certainly can make those adjustments and you pay the premium accordingly. Now on your farm and the production you put out in the field, you can put a 5% deductible on that, basically ensuring 95% of the revenue, but you're going to pay substantially higher premium for it. But guess what? The likelihood of collecting the claim is substantially larger because you have that much better insurance. You know, if I put a rock through the window of my house with a $500 deductible, I don't know that I'm going to turn it into insurance. Now, if I break my son, who loves baseball, he throws a baseball through 6 windows, he's probably going to get a lesson, some I hope he will, and then he'll pay for part of that and they'll collect the rest from insurance. That would be my goal. So again, how your operation, what's your risk level, you determine what that deductible could be. How much am I willing to risk, and how much do I want to lay off that risk onto an individual or crop insurance company and let them cover it, but I got to pay that premium. If everything goes well, I pay the premium every year and I never collect a claim, because what happens then? We've had good production, we've had good prices, we haven't had a fall. And again, all of these prices are following markets now. They used to be established prices. Some of our specialty crops, the RMA, the federal government, does just pick the price based, on their criteria. The vast majority of all these revenue now are following a market. And in most cases, it's the market that you're in. There's some exceptions. Example of barley actually follows a corn market to establish some of that, because there's not a readily traded market for barley in certain areas. But for the most part, it's following what the current market is, not your cash market. So again, you still have that cash basis risk locally, but we're looking at a national market price. So if I sat up here and asked the question, and you don't need to raise your hand, but if I say, how many people think corn's going to be over $6 come next harvest in 2024? Again, I say you don't have to answer it, but I still don't see any hands, and I would guess the vast majority might say, are we going to really be at $6? Maybe. There's a lot of things that can happen that can make us a $6 corn or $15 soybeans. We've had pretty good prices the last 3 years. Everything's cyclical. History doesn't always repeat itself, but you look back to the era of 11, 12, 13. We had pretty good prices then too. 2021, 22, 23, it actually started in 21. We've had pretty good rally and we stayed at these prices. Now we've softened a little bit. What's to happen afterwards? After 2013, what did we see our futures in corn? Hovered right around $4 futures for about 6 years. Our credit guys got a little nervous. Things got a little bit tight on the credit world of ag country with some of our producers because we had low prices. But those who had the risk mitigated and had the right insurance policy and tools being used to mitigate that, they fared okay. And then we had these good prices come and people are doing better again. I'm not standing up here today saying the prices are going to go down, but I'm just saying if we look at history, could it? Absolutely. Wasn't that long ago we saw $4 futures, sub $4 futures on corn. It could happen, maybe not. If you're, you just never know what these could do. So again, what risks do you want to mitigate? Again, everybody's appetite's a little bit different. So do I have a lot of debt on my farm? Maybe I'm a young producer and I'm just getting going and I had to buy some things, whether it was probably not land necessarily up front, but maybe it was equipment or things like that to get set up. I had to acquire a lot of debt to get going and get farming. So maybe my risk tolerance is I want less risk. So I might buy more insurance to offset that and let somebody else, because I just pay this premium and I know I don't have that risk anymore. And the market could crash. I don't have that risk. But if market goes up, I still benefit. That's one thing about insurance. It's not locking in your cash price. It's just looking at the market and giving you kind of market insurance. Some want to protect equity. I had a producer talk to me once. He said, I've been farming for 45 years and I've built a heck of a balance sheet and I never bought crop insurance. I got lucky, he said. Now I'm nearing retirement. I don't want to lose that equity I put in my balance sheet. With today's prices, cost of production, whether it's soybeans at $400, $500, $600 an acre cost of production, corn $700, maybe even $1,000. Some of our farther south edge territories, even over $1,000 an acre to raise a crop of corn. Well, you got, a few acres and you got a pretty nice balance sheet. Do you want to put all that at risk? Talked to two producers today in our booth that said if we hadn't got rain that first 2 weeks of August, which a lot of the area where he was at, about 2 weeks there, he got 4 inches of rain. He said he feels he would have had a zero crop, zero production. A lot of soybeans there. Soybeans are made in August, right? That's what rain does in August for him. He's looking at a pretty good crop, but thankfully we got rain. Do you want to risk that in it? Is there a tool out there? Do we have to manage tax risk? You just heard some conversation about the taxes here. There's all kinds of risk. Tax is another one. The risk-reward strategy. The more risk I take, the more I reward. Yep. Does a young producer want that? Probably, but do they want the risk? They had an example of somebody looking at retiring. Did they want the risk? They didn't. So they started buying crop insurance when they were 65. It was the first time he started buying crop insurance because he wanted to protect his balance sheet. There's a timing for everything. Again, no right or wrong answer. It's just for you and your operation, what do you want? So when revenue markets crash, but I look at a lot of things. If we have our expected yield on our farm, prices have to go down at least 25% for your 75% revenue protection policy to start paying. So quick math on 25%. Again, I'm looking at new crop here, roughly for simplicity's sake, let's say $5. But what's a 25% reduction on $5 corn? Math for all you guys out there, the calculator. $1.25, right? So take $1.25 off. I'm talking future levels, again, not cash in your pocket. We went from $5 down to what? $3.75. This area basis, normal basis, again, we know it changes. Say 25 to 50 cents off of that. $3.50 cash corn today, does that work for a lot of people's cash flow? $3.50? 200 bushel corn, that's only $700. A lot of cases we're raising 200 bushel corn, our costs are well over $700. Not all, but in many cases. So, but there's insurance there for you. If the prices fall down and you get your expected yield, we protected you at a 25% deductible, which is a pretty big deductible. On average, a 75% multi-peril policy, not counting replant, not counting prevent plant, just talking production and revenue, it pays out about 30%. 28 to 30% of the time, that 75% policy is going to pay out. And it might be just a little bit at that time. How much of a loss did you have? I just said $1.25. $1.25 at 150 bushels, that's quite a loss. That's a per acre loss. Now take it times 500 or 1,000 acres. It's even a bigger loss on that balance sheet. We talk about the other marketing risks. Basis widens, cash flow doesn't follow the markets. Yes, is it possible that we see it a lot where we see a rally in the national market, but our basis widens, so your local cash stays the same? But you can't ensure that. That's a hard thing to do. Short of using a marketing tool such as a basis contract to help protect that, that's one option. Again, just many options that are in the toolbox. We're always concerned about selling too early or selling too late. Again, I'm up here today talking about how does insurance protect that marketing? Insurance still puts a floor in that market, that national market price. Whether you sell too early or too late, you still have to sell. You still have to convert your commodity into cash, but at least we're at a higher national price, and if that national price falls down, then insurance will supplement your cash sale. So you might sell low cash, but then we'll throw you that insurance policy payment on top of it to help get you back up to where that national market was basically at. So switching here a little bit about hedging. I focus on hedging as something people are trying to offset their risk, right? Just like that's what insurance is quasi like a hedge. It's not a marketing hedge specifically, but you take an equal but opposite position in an openly traded market. If I'm long soybeans, I have a bunch of soybeans in the field or in my bin, I can sell the futures market to offset that risk, and I no longer have a risk in that market moving. It's one way to do it. As the futures price goes up, you're going to get a better cash sale. However, you're going to lose money on that hedge position. Margins on a truly hedged position is a good thing, typically, because you're not going to hedge 100% of your crop. You're going to hedge a portion. So you're going to get a better cash sale on the part that wasn't hedged. The part that was hedged, you're going to get what you expected. Again, that's a marketing tool. That's not an insurance tool. Similar concept. If insurance doesn't pay out because the price stayed at where you bought that insurance or it goes up, you're now able to liquidate that into more cash. If that price goes down, that insurance protected you and will get you back to where that national market price was at if you fall far enough. An individual policy, again, the vast majority look at a 75% coverage level. So you have a 25% risk in that. Most people I know don't buy a 25% deductible on their hail. Hail's paying you what you lost, right? And they don't want to lose 25% of that production. Multi-peril, most people would take a 25% risk. And again, you guys pick and choose which tool you want to use. But that's something I would look at. We still want that hail insurance to protect what we've lost as far as production there. But sometimes the other tools out there just ensuring that marketing price, you may look at having a little bit better or a little bit higher coverage. So again, this is just, I talked about, I ain't going to read all of the points up here, but we're trying to protect that balance sheet from the loss. Try to help protect you and use the tools. It's just a part of the risk management plan. Like I said, you can never take out all the risk, just using the multiple tools to take out as much as you can in that section or that way. So what can insurance cover? Basically, we can protect you from a market movement. Mostly market movement down on revenue side, but also a market movement up on your input side. You start looking at what it takes as far as inputs, fertilizer, not all of them, but look at fertilizer, look at interest rates, look at diesel fuel, some of those things. They have a market now. I think Josh is going to be here tomorrow or the next day, Josh Lynn from StoneX, talking about fertilizer prices. You ask him a question, he'll probably say 5 years ago, the fertilizer market was pretty boring. Yes, it moved, but it wasn't that exciting. In the last few years, it's gotten pretty exciting. There's a lot of moving parts in that fertilizer now. There's risk of that price going up, and benefits of it going down. Crop insurance has a way, margin protection, where you actually insure your margin. So we balance out the market on your inputs versus the market on your revenue or your output. What's that margin in between there? And then what happens, in the future at harvest time, did that margin get pinched? If they both go up and your margin stayed the same, that's still a good day because you're still making the same margin when you locked in that insurance policy. If they both go down, you're still making that margin potentially. It's when they get pinched that pays out. And that's a 95% where it only takes a 5% movement and all of a sudden that margin is paying you out. Another tool in the toolbox, and I think later on Thursday we'll have some folks up here talking about that a little more detail. Again, they do cover, like I said, short revenue, utilizing either area or individual plan. The decrease in margin I already talked about, but it also protects that marketing in your bushels. A lot of people still like that individual policy because then I can market these bushels and know I'm protected, that if the market goes against me and I don't produce the crop, insurance is going to protect me. So it gives you the flexibility to use some of these other marketing tools as well to protect yourself and lay off some of that risk. And again, of course, lost bushels too, it protects what you don't have up to a certain level of your average that you raise. Again, don't be afraid to ask questions. Very informal if you can. Listening to me talk gets me kind of long-winded sometimes because I'm one of those crazy insurance guys, so feel free to interrupt. So marketing tools. I talked a lot of some of the insurance tools and how they protect. Some of these marketing tools do the same thing, but they have different constraints or different requirements in how you do it. Obviously, you've got the easiest and simplest marketing tool that's out there, a cash contract. I'm going to deliver X bushels at X price. You have taken all the risk out of those bushels. Your only risk is producing that bushel to deliver. And that's where insurance can help. See how these two can correlate? See all of a sudden they kind of tie together? I don't want to get ahead of myself, but see how those two tools together can work. Selling the futures, same concept, or at least locking in a futures price. A national price, a hedge to arrive is basically similar. You just haven't locked in the basis. And you can call it what you want, but basically we're locking in the futures, and later time we're going to lock in the basis. Again, same thing as the cash contracts. Your crop insurance individual policy protects you individually. If you don't raise that 75%, you can still sell that. And instead of having to go and buy back those bushels, you still have to buy back those bushels, but instead of using your wallet or your checkbook, the insurance company is going to give you a check and say, hey, use our proceeds to buy back. And then at the end of the day, you're still going to get what you expected on those bushels. So now again, we're correlating, alluding to what we're going to talk about here in a little bit. Basis contracts, I'll say there's really no insurance for that. I don't have an insurance policy that can protect your basis. Your basis risk is you're a victim of your area, or you're a beneficiary of your area. Something happens, all of a sudden we put up a soybean plant, we put up an ethanol plant, we all of a sudden have strong local demand. Your basis is going to strengthen. One of those plants, unfortunately, has some adversity and shuts down, and all of a sudden we have a flush of supply in that area and not the demand. You're a victim of the basis is probably going to widen. They haven't invented insurance policy for that I know of. Again, just another tool that's out there that you can look at with your local elevator or whoever you're selling to possibly take off some of that risk. They can also be a hindrance. Sometimes you lock in a basis and you never see that opportunity to lock in the futures price, and at some point in time you need to, and you might have to do that in a low market value or low market price, so there is risk there as well. Every tool takes out a lot of risk. Some tools add some minor risk, and so there is some of that. And again, looking at the marketing tools. Buying puts on the commodities, similar concept, we're putting in a floor. However, if you're in cattle or livestock, maybe it's too big of a contract that you have to buy. You're a smaller producer, grain producer, maybe it's too big of a contract because those certain size contracts you have to buy, maybe they don't work. Maybe they work just fine for your operation. That's where, again, we look at personalizing this for everybody and what the risk that they want and what they want to take out. I said buying calls on an input. If I buy a call on an input, what am I basically protecting? That price goes high, I can buy it at that lower price. I should explain buying a put. If the price falls, I get to sell at that high price. That's what a put allows. So the puts and calls can be, like I said here all day talking about puts and calls, trying to explain how they work. But the basic majority, the concept of it here is putting a floor on your revenue side, putting a ceiling on your input side. Get back to where I talked about even margin protection, where we're looking at doing that. That's a tool that possibly can work similar to how those work. Or maybe even buying a call on a sold commodity. You've already put the floor in the price because you sold the futures or you sold it cash, but something happened in the market, we think this price is going up. You can capture some of that using these calls. Again, that's a marketing tool. It's not an insurance tool. It's a marketing tool, but again, it's part of the tools in your toolbox. You can get into window and fence strategies, for those of you who understand that, where you're buying a put, selling a call. You can do something similar to that where you buy insurance and sell a call. You can put the two together. Seen it more with some of the livestock areas, which are strictly revenue, not production based. Some interest in some of that, but again, putting these tools together. So the correlation between the two. So hopefully if I haven't explained that thoroughly enough, that maybe this slide will help me do that a little better. But crop insurance today is using the national market price. We're following what these markets are being traded at somewhat of a national level. And we're using that to set your guarantees. And then basically if our prices fall down, so again, the revenue policies, we're using a projected and a harvest price. So it's worth X today, setting that projected price. And if it goes down, we're still guaranteed up here at X, and it takes more bushels to get back to that total revenue. So we're gonna cover that loss in revenue. Doesn't matter, you maybe had raised your average history, but all of a sudden now we still get paid a claim because the price, it was like price insurance. As the price went down, you get paid. So again, they work that way. And if prices go higher, in a lot of these cases, we establish a new guarantee at those higher prices just in case you didn't get the production. So now we're covering the loss you would have had because of production, plus the loss in that revenue, because the revenue went higher, we get to sell at that higher price. And so again, we're protecting both ways when it comes to revenue. Did I miss out because the prices went higher and I didn't have bushels to sell? Guess what? This covers it. Did I raise what I expected, but price fell, so I'm not going to get good cash? Yeah, but guess what? The revenue protects it as long as you hit your trigger points. And so how much of that trigger point are you willing to risk? Area plans have really come out lately. There's getting a lot of traction on that. That's mainly the enhanced coverage option, which is ECO, supplemental coverage option, SCO, and then margin protection, which is MP, is the acronym. So you don't expect you to memorize that, but basically there are different levels. ECO and SCO, you can buy 95% or 90 on ECO. SCO goes to 86% and covers you below that. The margin, again, is a little different animal where we look at revenue and cost and we're protecting that margin, but you can buy 95% on that. They've gained more attraction. They're much more expensive than your normal revenue protection policy. I'll be flat out honest with you, they cost more because why? I said it was about 30% that 75% policy pays out. If you go up to 95% on one of these plans, the likelihood of collecting is more like 50 to 55% likely to collect. But those 45% of the time where you don't collect, you're gonna pay a pretty good premium bill. Now, in the long run, the way crop insurance and RMA is supposed to go, they should even out eventually. Where every dollar paid in, you should get paid back. That's how they're supposed to work. So area plans, like I said, really, we've seen the focus on those mainly just looking for price protection and the market movements. There are some other unsubsidized products out there that allow additional price selections where you can get up to that 95%. But for those of you, if it's unsubsidized, you're paying the full risk as opposed to the government paying part of the risk. Much more expensive. I said these were expensive. Those are on an individual policy are even more expensive because they're one individual and two, they're not subsidized. So some risk there as well. Do we have a question over there? Nope. Okay. All right. Check it. This is a real busy chart, but there's a bunch of lines up here, but the biggest thing I want to show is on the far left where it says MP price of 611. This is a corn example. Basically, 95% of that is 580 futures price. If we fall below that line, the second to the top red line, we're looking at a payment, just looking at price movement. There's a lot of the time this looks like it'll pay out. We still wait till October, till harvest, when we actually look at the fall price. The time will tell. A bunch of other ones are all the other SEO, ECO. So again, just ways I look at, these are my insurance policies. These are some of the price points that protect me. And that's what I encourage you to look at is these some things that you want to protect with. This is soybeans, same concept here. Our projected price started at $13.76, but then at what lines do my insurance start protecting? Right now, actually, soybeans have held their own. And just price movement alone isn't looking at paying. But again, we've got a decent price relative to what corn started at the beginning of the year. I think just a couple more here. Insurance policy really starts your marketing plan. It kicks off the year. We establish a price, a coverage level. What do we want to protect? Again, can't say this enough. It's national prices, not your cash price. A lot of these will establish a floor and then protect if the prices fall. I did talk about livestock in that too. So I think what to remember basically is a good communication with all your professionals, whether it's your lender, your insurance agent, your tax person, other things too, and your family and your partners. Whoever you're working with your operation, those types of things you definitely need to keep good communication as well. Having a plan is really the first step. Through that communication, come up with a plan so everybody knows what page you're on. What are we trying to protect? What's our goal? Having that something to keep in mind, take back to your business. Again, don't assume anything, ask questions. If you don't fully understand a product, whether it's a marketing tool, a crop insurance tool, any of those things, if you don't understand it, ask the questions. I always say keep it simple. Make sure you understand. If it's too complicated for you to explain to somebody else, you probably don't understand it well enough, there could be risks there that you don't know you're getting into. You may only see the positives. Sometimes we get blinders on it, we don't see the risk. So keep that in mind as well. You still have to pull the trigger and sell for cash. That is still on you. These tools expire, whether it's a marketing tool or an insurance tool. There's an end date that tool stops protecting you. And if you haven't sold cash, you now take full market risk. It only protects you until they expire, so make sure you know where that is and how that works. Your toolbox has many tools, find the right fit for you and your operation. Lots of options there. So with that, again, I'll open up to any other questions. I appreciate you guys for attending. Who's got the first question? Either put them all to sleep or I answered everything they wanted to know. Good deal. Yeah, there's one. Do I remind people of the date when the date's approaching? When it comes to crop insurance, it's pretty simple, yeah. When you get into the marketing side, you have options and futures that expire at different points in times. Now, I would say most brokers are probably going to have a list of, okay, these people have this and we should give them a call and email. We are not a broker. We don't do any brokerage. We're just purely education. And we sell the insurance side of things, but we just educate. So I would say when it comes to insurance, yeah, we should be sending out notes saying, hey, October is the big date for corn and soybeans where we finalize our price. August is the big date for your wheat, spring wheat specifically. Those are very well known and probably versed. When it comes to some of the other marketing tools, that's up to the individual broker. But I would say for the most part, they usually do a good job of that. Good question. Any other questions for me? Yep.
Do prices at the beginning of the year affect the crop commodity prices affect what insurance rates are going to be for that year? And what do you want to see in the beginning of the year for higher or lower insurance rates?
So does the prices at the beginning of the year for commodities affect the insurance? Absolutely, because that sets our bar. That sets our minimum guarantee price. Now, throughout the year, there's different policies. Right now, today, we're tracking corn, soybeans, and wheat for a market, for what they call a margin protection policy. So that's establishing your guarantee revenue for your 2024 crop year today. We're done averaging that on the 14th of September, excuse me. On the 14th of September, we've looked at the last 30 days, averaged them, and said, here's where our price is set. And then our premium is based on how much protection, how much price we have, as well as volatility. How much volatility is in that market is another factor setting your premium. So it's vital because that's where our minimum guarantee is. It's also vital because it sets the premium and what that's going to cost. Now in February, we're going to track those averages again of the new crop, but for a different insurance policy. It's going to be the revenue protection, the SCO, ECO. So today's price might be way different than February. We don't know. Waiting till February, you might get a better price. Waiting till February, you might get a worse price. And that's just a matter of knowing if I knew what the market was going to do, I'd tell you what insurance policy to buy. But that's where, what is the risk you want to take off? What concerns do you have? Then we try to put together a plan that can possibly help. Again, insurance is the start, and then throughout the year, you have to look for opportunities to sell it and convert it to cash, but know you're still protected with that. So it definitely sets the tone for the year when those insurance prices are set. Again, mainly right now, from August 15th to September 14th, and then again in February, where are the markets? And then they both wait until October of the harvest year, and that's where you get your harvest price. Good questions. Okay. Well, if there's no other questions, I appreciate your time. Thanks for coming out to Big Iron. There's a lot to see. Great day today to be out walking around. Sun is shining, a little bit cool, but a good day for a jacket, not too bad. So thanks again, appreciate it.